Warren Buffett has an amazing track record of 19% annualized returns since 1965. For years, I was obsessed over Buffett's strategy and I read everything about Buffett that I could get my hands on, and I watched every available record of Berkshire Hathaway meetings. Finally, I solved this strategy and reduced it to 5 simple steps. In this video, I'm going to walk you through these 5 simple steps so you can also pick stocks like Buffett. If you internalize the logic behind these 5 steps here and religiously implement them in your investing process, there is no reason you shouldn't make much money in the market. With that said, let's start with the first step, which is understanding the business and staying within your circle of competence.
I have an old-fashioned belief that I only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that.
Buffett himself religiously follows this step, and he rules out any investment opportunities if he doesn't understand the company. All of his big winners were simple businesses like Coca-Cola, American Express, Moody's, and Bank of America. Most people buy businesses they don't understand, and if we are in a bull market, everything can go well for some time, but the market crash eventually comes and everybody panics. If you are holding a business that you don't understand, you end up panicking even more than other people and you sell your position for a loss. But if you understand the business, market crashes may be the best times to buy them because they get incredibly cheap. Buffett bought Coca-Cola just after the 1987 market crash and Bank of America after the 2008 crash. So you should be good as long as you buy at cheap prices, right? Well, actually what company you buy matters way more than the price, and that brings us to the second step, which is buying businesses with durable competitive advantage.
What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about. I mean, you may want to be the lord of the castle yourself, in which case you don't worry about that last factor. But what we're trying to find is a business that, for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage. For any kind of reason at all, that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try, if you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide, and most moats aren't worth a damn in capitalism. I mean, that's the nature of it, and it's a constructive thing that that's the case. But we are trying to figure out why is that castle still standing? And what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now? What are the key factors, and how permanent are they? How much do they depend on the genius of the lord in the castle? And then if we feel good about the moat, then we try to figure out whether the lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses.
A moat, or a durable competitive advantage, protects the business against competition and ensures that the business thrives in the long term. Every company might have different moat, like brand recognition, network effects, or economies of scale, but they all work in the same way. They protect the company against competition. Let's take Facebook as an example. It has billions of users creating amazing network effects. If I was an advertiser, I would advertise where there are billions of people, and if I was to create an account in the social media for the first time, I would do that where my friends are. So it's actually near impossible to shake Facebook's dominance, even though creating a social media application is relatively cheap and simple nowadays. So the main question is how we can find those businesses with wide moats around them. This is not an easy task, but Buffett gives us some indicators. He thinks that high return on invested capital and higher gross margins than competitors are the early indicators of the businesses with a durable competitive advantage. The logic behind this is pretty simple. If the consumer willingly pays higher premiums for the product than the products of the competitors, it must have some kind of advantage that the competitors don't have. When you find that business, chances are great that it has some kind of competitive advantage. But even if you find that business, this doesn't mean you can buy it right away. It has to be attractively priced, and this brings us to the third step, which is paying the right price. No matter how great the company is, you won't make much money if you overpay for its stock. You have to find and buy those great businesses at attractive prices so your initial return will be high enough to justify the risk. Buying stocks at bargain prices doesn't just provide us with a higher initial return rate, but it also does something much more important. It mitigates risks. This is called the margin of safety, and Buffett himself insists on having some kind of margin of safety.
You calculate, I think you take all of the variables and calculate them reasonably conservatively, but you don't try and put too much windage in at every level. And then when you get all through, you apply the margin of safety. So I would say don't focus too much on taking it on each variable in terms of the discount rate and the growth rate and so on, but try to be as realistic as you can on those numbers, but with any errors being on the conservative side. And then when you get all through, you apply the margin of safety. Ben Graham had a very simple formula he used for just the most obvious situations, which was to take working capital, net working capital, and try and buy it at a third off working capital. And overall, that worked for him. But that method sort of ran out of steam when the sub-working capital stocks disappeared. But it's the same thing we do in insurance. I mean, if we're trying to figure out what we should charge for, we'll just say, the chances of a 6.0 earthquake in California. Well, we know that in the last century, I think there have been 26 or so 6.0 or greater quakes in California. And let's forget about whether they occur in remote areas. Let's just say we were writing a policy that paid off on a 6.0 or greater quake in California, regardless of whether it occurred in a desert and did no damage or anything. Well, we would look at the history and we'd say, well, there have been 26 in the last century, and we would probably assume a little higher number in the next century. That'd just be our nature, but we wouldn't assume 50. If we did, we wouldn't write any business. So we might assume a little higher. If I was pricing it myself, I'd probably say, well, I'll assume they're going to be 30 or maybe 32 or something like that. Then when I get all through, I'll want to put a premium on it that now puts in a margin of safety. In other words, if I figured the proper rate for 32 is $1 million, I would probably want to charge something more than $1 million to build in that margin of safety. But I don't want to hit it I want to be conservative at all the levels, and then I want to have that significant margin of safety at the end.
We can't 100% understand or predict what's coming for the business in the future. We can only have educated predictions. Those predictions tend to be more accurate as we better understand the business, and biggest margin of safety, therefore, is not picking a business you don't understand. In any case, even if you totally understand the business, margin of safety still protects you against unpredictable events in the future. Talking about the prediction, we have one more way to protect ourselves in the market that actually makes up the fourth step in Buffett's investment process, which is smart diversification. Everybody knows that Buffett is against diversification, right? Well, not exactly. He's not opposed to diversification. He is opposed to extreme diversification.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And
as you see, 80% of Buffett's portfolio is invested in just 10 stocks. For Buffett, this is enough diversification. He thinks that an intelligent investor should buy exceptional businesses at attractive prices and should buy a basket of them. Buffett calls this smart diversification. As Buffett says, if you really understand the business, you don't really need that much diversification, and excessive diversification is potentially going to reduce your returns. Why? That's simple, because there aren't that many great businesses in the world. We only have 1 Apple, 1 Microsoft, 1 American Express, and so on. Great businesses are rare, so anytime you add a new stock in your portfolio, you risk diversifying away from greatness, and this is not how you make money in the market. Another reason against diversification is that as you have more and more positions, it gets exponentially harder to keep track of all of them, and over time you will become a stranger to some of the holdings in your portfolio. This is a recipe for a total disaster. Imagine the 2008 financial crisis is underway and you forgot you had a Bank of America in your portfolio. You can't afford to do this. You have to buy exceptional businesses and buy a basket of them, but your basket should be small enough so you can keep track of your holdings. So we have a basket of great businesses that we understand and purchased at attractive prices. What's next? What do we need to do last? This brings us to the final step in Buffett's investing process, which is holding as long as you can.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote.
Average holding duration for an American investor is just 6 months. For Buffett, it's 7 years. But when you focus on his top positions, you see he has been holding many of them longer than 10 years. He has been holding Coca-Cola since 1988, American Express since 1993, Bank of America since 2007, and Apple since 2016. If you could find a business that can grow its earnings consistently for years, it's a big mistake to sell it for small profits, because what you are doing is essentially interrupting the compounding machine. Let's say you invested $10,000 in a company and it doubled in price, and then you sold your position. In this case, you would make a handsome $10,000 in profit, right? Not bad. But let's assume its price will increase just 10% annually after it doubled, and let's see what happens if you can hold it for 20 more years. Your initial $10,000 investment would double to $20,000 in the first year, and then 19 years later, you would have $122,000. This is the power of compounding. Does this mean you should never sell? Of course course no. Even Buffett sells if he sees the fundamentals of the business is breaking and its moat is eroding. Long story short, you should keep those exceptional businesses as long as you can, and you should keep track of the fundamentals so you can see when the moat around the business starts eroding, and this is the time you should consider selling. This brings us to the end of this video, guys. Please hit the like button and subscribe to the channel, and see you guys in the next video.